How to invest 1 crore rupees? Well, this is not a clickbait. This video is going to be highly informative if you are a new investor and serious about investing. You are going to get too many insights on how to invest your money. Hello and welcome to our channel 5 Minute Finance by ET Money, where we talk about the basics of investing and personal finance. Now, where do you get that 1 crore rupees is not our agenda of discussion today. Then why did we take a huge figure of 1 crore? Well, 1 crore is a lot of money and investing it properly needs good planning. Everyone would agree on that. But when people start investing with smaller amounts, they often don't follow a smart plan. Many new investors just act out of fear of missing out, and that's where the blunder begins. So in this video, we are going to discuss the 3-step approach to invest in the right way. So be it any amount, 2,000, 5,000, 10,000, 10 lakh or 1 crore. Take investing seriously from the very first day itself to do it right. So let's get you started with the first step. So first and foremost, you need to decide the purpose of your investment. Why do you want to invest? And by the way, FOMO cannot be the answer to this. Just because your friend or neighbor has made some money cannot be your reason to start investing. You need to be very clear about what is the goal that you want to achieve by investing. You can have different goals like retirement, your child's higher education, your child's marriage, foreign or domestic trip in some time, buying a car, buying a house, and so on. Defining a clear goal will help you decide the timeline of investment, that is, for how long you want to invest. Now, the time period for which you need to invest will decide where you can invest. For example, if you are 35 and you want to invest for your retirement, then you have probably 25 years to invest for the goal. 25 years, a very long time period. So you can take some risk with your money to earn high returns on your investment. Now we'll discuss this later in detail. Let's take another example. Suppose you want to invest for your child's higher education who is currently 12 years old. Here you have say 6 to 8 years of investment horizon. Now for this time range, you will need to balance between high return investments plus some stable investments, as the time period is not very long enough for very high equity exposure. So once you have answered the why of investing, you need to define how much to invest, and well, that will depend on the current cost of your goal. So suppose your goal is your child's higher education. The cost of same is 50 lakh as of today. You need to increase this goal value for inflation, which is around 10 to 12% for higher education. So if the cost of education is 50 lakh now, and after 20 years it will be 3.33 crore, assuming an inflation rate of 10%. So you know why and how much to invest. Next, let's move to where to invest. Now there is not one answer that fits all. There are many factors that come into play while deciding where to invest. There are different products with different risk and reward ratios. The table on your screen shows the returns that different products can offer you. Let's look at equity first. So equity means investing in stocks. For that, we have taken Nifty 50 TRI index, which has delivered 14.13% on an average for a 15-year period. It is the highest returns among all kind of instruments. Now, there are no instances of negative returns. In fact, the lowest return it has generated is 8.5%. Debt instruments can give a return anywhere between 7 and 8%. As most of the debt instruments, especially debt funds and bank FDs, are taxed at marginal rates, the post-tax returns are much lower. Another popular instrument among Indians is real estate. Most people invest in residential real estate, where the returns are generally in the range of 6 to 7%. Plus, there are issues like liquidity, maintenance cost, etc. As per National Housing Bank's Composite Housing Price Index of 50 cities has grown by around 5% annually between June 2013 and March 2024. Well, if you look at the current inflation, the returns from debt instruments and real estate may not look sufficient. But it may not be wise to put all your money in one asset class, that is equity. Therefore, what you can do is, depending on your risk and return assessment, you can spread the investment across instruments. But how will you know your risk profile? Well, for that you can go to the ET Money app and take the Investor Personality Assessment, where you have to answer a few questions, and based on that, this assessment tells you your risk profile as an investor. This whole exercise hardly takes a few minutes. Now the best part. It also helps you with the suitable investment options based on your investor personality. So, if you are new to the field of investing or you are a seasoned investor who has big corpus to invest, well, both kind of investors need to explore the investment personality assessment, as everyone needs to invest as per one's risk appetite. And this brings us to the end of this video. If you liked it, please subscribe to our channel and share the video with your friends and family as well. Also, don't forget to press that bell icon to never miss a video from us.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.